Hi, Joe Kehrig with the Kehrig Real Estate Team, and welcome to 2023 and your 2023 real estate market update. You know, we've got a lot to go through. You hear so much on the news. As we talked about a couple weeks ago, what you're really reading in the headlines doesn't really exist, or they're pulling like little pieces out. So let's really look at what we really expect 2023 to look like. You know, first off, you know, Jerome Powell, who obviously controls the monetary market with the rest of the Federal Reserve, basically I say if you're a home buyer, someone or a young person looking to buy a home, you need a bit of a recess. We need to get back to a place where supply and demand are back together and where inflation is low again and mortgage rates are low again. You know, it's so funny because Jerome Powell is, you know, I'm sure a very intelligent person, but when you're boots on the ground, I hear him say stuff, or I hear him say that, hey, he's going to quit raising interest rates when the inflation rate gets to 2%. What I don't understand, and I'm a simpleton compared to him, is the fact that those two things don't go together. When you lower the rates, it puts more money out there in the economy. People can borrow more, they can spend more, inflation goes up. So he talked about he's going to quit raising rates when the inflationary rate gets down to 2%. I'm not sure that we're ever going to see that, and I'll tell you why, is because the way the government is printing money, that's what is really driving the inflation. Because when you print a lot of money, it puts more money out there in the economy, more money to spend, and obviously raising the interest rates tamps that down as it is. You know, the home market has gone down, car sales, people don't have the money, it costs more to purchase stuff, so people are buying less. And we've seen the CPI the last couple times go down and interest rates have settled down a little bit. So the fact that he talks about the supply and demand being balanced, you know, we have to get back to a balanced supply and demand. I'm telling you right now, that's not going to happen. For 14 straight years, the home builders built 400,000 to 500,000 homes less than what they needed to every year. So in the last 14 years, there's been about 6 million homes that haven't been built that would have normally been built. And plus the millennials are in the peak of their buying season, and the millennials are bigger than the baby boomers. So literally, you have a situation where that supply and demand is going to be out of whack for a while. You've definitely seen inventory go up, but it's not because there's a lot more homes coming on the market. It's because a lot less people are buying, and obviously you'll see that. Well, we'll share the information. So one of the things that's worrisome for me when I listen to Jerome Powell talk, and he talks about having a balanced supply and demand and talking about he'll quit raising the interest rates when inflation gets down to 2%. Well, I guarantee you, if the interest rates go down, the inflation's never going to get down to 2%. To get down to 2%, rates would probably have to be like 15%. So we'll see. Obviously, I think he's just, you know, putting it out there. But I think he realizes, because he's a smart man, I think he realizes that that's really never going to happen. So when you look at this chart, you can see that 2022 was defined by the rapid rising of the interest rates. Interest rates for the first year ever more than doubled. You know, they started at 3% and now they're over 6. They actually got up to over 7, but you can see that they kind of peaked. So I think interest rates are somewhat peaked, and they've been going down because, again, the people loaning the money for the homes kind of see that the Federal Reserve is backing off a little bit. Inflation numbers are getting a little bit better, not quite as good as they wanted them to be, but they're getting a little bit better. So you're seeing the mortgage rates actually go down. So I think we'll actually see them go down a little bit more, because what's happening is, you know, obviously, like we talked about before, the Federal Reserve keeps raising the interest rate to tamp down the inflation. And now that the CPI numbers, the inflationary numbers, have calmed down a little bit and are going down slightly, not as much as they'd like to see, but they're going down, they're starting to back off. Now, they just raised the rates after months and months and months of 0.75%. In December, it was 0.5%. They anticipate next week it's going to be just 0.25%. So what you're going to see is basically the mortgage rates getting a little bit better the better. Really what we're hoping to see by into the spring sometime, because when you follow the 10-year Treasury, mortgage rates basically follow the 10-year Treasury, and they have for decades. Right now, if you looked at where they should be and looked at the delta, mortgage rates should be 5 to 5.5%. Well, they're about 6.5% because of the artificial raising of the interest rates. So that's one thing. We're kind of seeing the interest rates peak, and we're starting to see them come down a little bit, which obviously is good news. I don't think we're going to get into the 3 or 4, and that's one of the reasons that we're going to have a lack of inventory, why it's never going to be balanced demand, with supply, because there's so many people out there. Matter of fact, a high percentage, over 50%, have mortgage rates of less than 4%. So they're not going to necessarily just sell to sell and jump into 6+% mortgage rates at this point. So look at the mortgage rate projections, obviously through quarters 1 through 4, almost across the board. They're all thinking that they're going to be any place from 6 to 6.5. Now, again, they really should be 5 to 5.5. This is what's being done artificially, by the Federal Reserve to raise the interest rates. So, and mortgage rates could pull back meaningful next year if inflation pressures ease. That's Greg McBride, the chief financial analyst for Bankrate. And that's exactly what we talked about. If we start to see inflationary go down, then obviously we'll see, the CPI numbers, consumer price index, go down. Then we'll see the interest rates ease off a little bit. But again, the problem that you have is the minute interest rates start easing down, you're going to see inflation start going up. So it's really, it's a balancing act that is not easy. Obviously, looking at it from boots on the ground type of a thing, the easy thing to do, which isn't that easy for Washington, is to quit printing money. And they would control the inflation much more that way. But they have a reluctancy because of obviously their everything that they want to give to basically quit printing the money. But that's really the key, but I'm not sure that's going to happen. Look at the total home sales from 1999 to 2022. You can see that they anticipate next year to be just over 5 million, which again, when you go back to 2013, 14, 15, that's kind of what we've seen with an average. Much less than it's been the last 3 years. But again, that's because there's not as many buyers out there, so you're seeing more inventory, but it's really not so much more inventory, but it's the lack of buyers out there willing to pay 6%, or they have a 3% interest rate now and they don't want to get out of that and go with 6. So anybody buying right now really has a need to buy. No one's doing it recreationally like we did the last couple years. You look at 2023 total home sale forecast, again, across the board, they're thinking right around 5 million. Lawrence Yun, who is a chief economist for the National Association of Realtors, and he is definitely, if he's in a room of economists concerning real estate, he is the smartest guy in the room. He goes, the upcoming months should see a return of buyers as mortgage rates appear to have already peaked and have been coming down since mid-November. So we're going to start seeing the buyers come out. And again, we're not going to see, real estate prices come down meaningful. We had that 10 to 20% correction, but I don't think we're going to see them come way down because we're not going to see that much more inventory come on the market. Certainly more of a normalized market. Like we had before, where if a home's worth $1.5 million, it'll be priced at $1.5 million, take 30 to 60 days to sell and get one offer. That's a normal real estate market, at least in my 45 years I've seen. Home price forecast from 2023, you can see all the way from going up 5%, going down 5%, it averages out to about 0. That's where I think we're going to be. It might go up a couple percentage points, down a couple percentage points, but for the most part, we saw that 10 to 20% correction. Market has stabilized, rates have stabilized, coming down a little bit. Where supply and demand is still out of whack. So I think we'll still see a strong market. It will just be more of a stable market in 2023. Mark Fleming, the chief economist of First American, says a housing market once adjusted to the new normal of higher mortgage rates will benefit from continued strong demographic-driven demand relative to overall long-run shortage of supply. This is exactly what we talked about. It's kind of the new normal. Rates drop down to 5.5 right now. People are going to say, oh, this is great. Where before, we were getting 3%. It's kind of like looking at gas. All of a sudden, we go buy gas now and we see it for $4. We go, oh my God, it's only $4. Well, a couple of years ago, we would have said that's outrageous. So again, Just like gas prices, the mortgage rates are kind of the new normal. If we go down to 5%, I think people will look at that as a positive, and not that Disneyland, year that we had 2 years after COVID when they drove down the interest rates. Now, interest rates will go down more as we pull ourselves out of this recession, because remember, they raise the interest rates to push us into a recession, to slow down the market. And then what they do is they lower the interest rates like they did after COVID, when we went into a recession after COVID, to pull us out of the market. The only problem with the real estate wise is it lowered the interest rates, but the real estate market was still hot. It was hot before going into COVID, and the 3 months after we came out of COVID, it continued to be hot. So it just was like pouring, lowering the rate was like pouring kerosene on a fire. Doug Duncan, Chief Economist, Fannie Mae, from our perspective, the good news is that the demographics remain favorable for housing, so the sector appears well positioned to help lead the economy out of what we expect to be a brief recession, which is basically, I think, through 2023. But I think we'll start to see from the real estate market strengthen. As far as the rest of the economy, I don't know. I think it's going to be soft, but I think the real estate market, because of the supply and demand, is going to stay strong. Every market is individual, but if you have any questions at all, please reach out. Again, Joe Kehrig, the Kehrig Real Estate Team. You can give me a call, 925-487-6838, or drop me an email, joe@kehrigteam.com, or visit our website to learn a little bit more about us, www.kehrigteam.com. We'll see you next week.